Hi there. During our most recent client webinar, we were asked some really interesting questions. And, being the person who likes efficiencies, I thought, well, if these 6 or 7 people were asking questions out of the 1,500 or so families that we work with, I'm sure a lot of the people have these questions. And so I printed off some of those questions, and I thought we'd go through them today in this special video. The first one was explain in layman's terms the bond market. How do bonds relate to the Dow, if at all? Quite simply, a bond is just issued by somebody that wants to borrow money, whether it's a corporation, your local city or county, your state, the federal government, foreign companies. When they want to borrow money, they issue a bond. The interest rate that is charged is based on the risk. That's both the time horizon of getting the payback and then how risky financially that entity is. Now, the question of how this relates to the Dow, or I choose to use S&P 500 as a little bit more broad measure of the stock market, is multiple ways. And as the question came in, I tried to jot them all down. Um, First and foremost, most Dow companies borrow money some way or the other, whether it's short-term bonds or long-term bonds. They borrow something just for ongoing operations, and they also borrow longer term for capital improvement projects. Hopefully, more and more doing that lately, and we could keep the economy growing. But so as bonds change, if a bond yield goes up, the bond goes down in value. So as the company goes to issue new bonds or refinance the ones they already have, where the interest rates have moved to will play a very important role in their earnings, depending on how much they borrow. So, increase in interest rates overall is bad for the Dow or the S&P 500 because interest expense will be higher, earnings will be hurt a little bit, and the stocks related to that should go down in value. One of the other things that most people probably aren't aware of is the valuation models that Wall Street uses, where they discount earnings and the cash flow back, are based on interest rates. So as you have changes in interest rates, some of the studies I've done as I went through the CFA program was the bigger the interest rate move, the more negative impact it's going to have on stocks if interest rates are going up, which is, I believe, where this question was coming from, because that's all you hear about in the media is how interest rates are going higher. It's because now the cash flows become a lot more risky as interest rates go higher, so the stock should be worth less. In some cases, if they borrow too much, worthless. But I'm sure if they're a Dow component, that's not the case. But I think most importantly, what we really miss out on, and all these people who are talking about in the media about the problems with bonds and interest rates going higher, is bonds play a critical role in the underlying economy. Whether it's your credit card bills, auto payments, you name it, your mortgages, changes in interest rates to the upside has a very negative influence on the economy, and then that of course hurts all the Dow companies. As economic growth slows, so do their sales, and that's the biggest thing that I think I'm worried about. And all these people that say don't worry about a bond sell-off, that means you should buy stocks. I've never seen a time where bonds went through a really bad bear market and stocks were immune to that. In fact, stocks almost always will go down more than bonds in that situation because the overall economy is so bad. So that's something at SEM that we're keeping our eye on very closely. We have economic models that are indicating that, and it's something that we need to keep an eye on. So next question. This was a good one. Investment growth is never guaranteed. Understand and accept. But in solid economic growth market, but in a solid economic growth market like the last 6 months, losing money is not expected, nor an acceptable investment result. Okay. Please explain the loss and also SEM's plan to reallocate investments to protect against and minimize losses. Did you jump in too early into the bond market expecting the inevitable stock market correction? That's definitely a fair statement. There's a lot of pieces to that, looking at that question. First of all, over the longer term, the stock market should go up if the economy goes up. In fact, my studies have shown 90 to 95% of the overall stock market's move is related to the actual economic direction. And then even going a little bit further, 90 to 95% of a stock's move is also related to the industry. So the industry goes up with the economy. The stocks kind of go along with it. That's the rising tide lifts all boats. It's why SEM chooses to focus on economic direction, and getting that right, and then the industry selection, and we stop there and we don't do individual stock selection. That's a long-term relationship. One thing that you will find interesting is people believe that it's a perfect example all the time where if the economy is strong, stocks are strong. But to that, you just have to look at what happened in the first couple weeks of February. The S&P 500 lost 10% in 8 trading days. Nothing changed with the economy. The economy was still doing great. In fact, it was improving when all of that happened. So why would the market lose 10% if economic growth is strong? So that relationship definitely falls apart the shorter time horizon you have, and definitely looking at an investment over 6 to 7 months is for sure an issue. Looking at SEM's portfolios, and we just on our webinar we were talking about the different types of portfolios we have. Our portfolios focused on the stock market, they weren't down. They were actually up when the statements closed in June and everybody got their report. So they did what they were supposed to do. The real issue is the bond market, which is a completely different animal. Now, over the long run, bonds will also somewhat track what's going on with the economy with a little bit different relationship. But what's interesting is bond investors focus more on the ability of all those issuers to pay the money back. In the previous question we talked about, the different types of people that might borrow. So with the focus on that, they care a lot more about what's happening beneath the surface because they're worried about getting paid back. A stock investor just wants to see growth. They don't care how it comes, where it comes from. As long as it's going up, they're happy. Bond investors are looking, how do I get my money back? And how do I not take on too much risk with that? So starting in early February, bond investors got very worried about both inflation, which totally erodes the value of the coupon payments they get on their bonds, as well as the fact that the tax cuts seem to just pull spending forward, and it's going to make it more difficult to refinance next year, where we have $4 to $5 trillion of bonds coming due from corporations all the way up to the federal government that needs refinance. So the bond market is a little bit concerned. Now, those concerns have been reduced a little bit lately, and I still think, though, if you look at the action in the bond market, they're skeptical still of economic growth. So we got to keep an eye on that. Deep down in that question is, I think, an assumption that SEM will try to get ahead of a move. I wish we could. If I had those types of indicators that could predict things that happen before they happen, that'd be great. Almost all of our systems are based on the momentum, the direction things are going, and then applying that to past relationships, going back through times and say, well, based on this, what's likely to happen going forward? And all the best indicators are lagging in that sense, in that when you see a big sell-off, like you saw in the first 2 weeks of February, that's always happened during a bear market. Doesn't mean it's always guaranteed a bear market, but that's a bear market sign. When you see that fast of a drop with that much volume, that's your sign, hey, get out. And that's what our systems did, both stocks and bonds. So they're more reactive, but they're trying to chop off those really big losses, because a bear market is a 6 to 24 month evolution of things where the market will go down and then it claws up a little bit and it goes down again and it claws back up. So that's important to understand, is a bear market's not a crash. It's just this very painful downward slope movement that we're not going to get out of right away. Secondly, my opinion means nothing in our asset allocation. Rick Gage's opinion means nothing. It's all based on rules, and we found that's the only way to navigate all the different things that are going to be thrown at us, is having these rules. But to get back to the last part of the question, what's our plan to get back in? We start getting back in late June, early July, and we're fully invested, whether it's our lower risk tactical programs that focus on fixed income, they're fully invested in high yields, all the way out to our AmeriGuard stuff and our dynamics, all in. Doesn't mean it won't change, but I think what's critical to understand that is having a plan is the key to surviving what has been a very emotional year. And as I mentioned in our webinar earlier, it's, we're ahead of the benchmarks now. We were below the benchmarks a little bit in June, and now we're ahead of them. Don't use the last 2 months or the last 8 months to evaluate things, but that's key. Is we didn't panic. We didn't have any sort of reaction of, oh my gosh, we're down. We just said the systems are doing what they're doing and what they've always done, and that's how we've been around for 26 years. Next question, actually 2 questions that really have the same answer, so I put those on there as one. How do I diversify our accounts so when this bull market explodes, I believe that person means implodes. I take explode to be moving higher like we've seen over the last 6-7 weeks. How do I diversify our accounts so when this bull market implodes, we don't lose everything? And the second one, I am 11 years from drawing from my retirement accounts, TSP, Roth IRAs, 401ks. TSP, for those of you that don't have it, thrift savings plan, federal government plan. This could mean any pensions, any other types of retirement plans that your employer might have. So based on the predicted overdue drop in market performance, must be reading my blog, should I maintain my current growth and income profile or head towards a more conservative investment profile as I continue to contribute to these accounts? So that's very loaded questions. First off, I think it depends on your overall financial plan. What's your time horizon? When do you actually need this money? Just because you're retiring in 10 years doesn't mean you're going to be taking it all out 10 years from now. Also, what's your personality? Are you going to be able to live through a possible 50% drop in the stock market that will be accompanied by some negative headlines? If the answer is I don't know or I don't think so, then it probably is time to look at reallocating some of that. During the webinar, we talked about the Buffett indicator. Other valuation indicators are saying the same thing. Of the next 10 years, because you're buying at such a high valuation, your returns are probably going to be quite low. So trying to squeeze out a little bit more is probably not something that I would recommend, because oftentimes what we see is people are not able to react without a well-defined plan and exit strategy that's been tested over time, like what we use. The accounts managed by SEM, we do the diversification for you. We got out of emerging market bonds earlier this summer when it looked like they were a good value. Our systems bought, they started going back down, we got out. So the diversification we had there is now in some short duration bonds. We're in high yields. We take care of all that diversification of not only asset classes, but we're big proponents on getting you into multiple strategies at SEM. We have tactical programs, which are basically daily managed things that are trying to chop off losses as quickly as possible. We have our dynamics that are based on my economic model. And then we have AmeriGuard, which is a beautiful blend of American funds and Vanguard to give you more of that long-term exposure. So we will do that for you. If you're not with SEM, circle back with your financial planner. A lot of times people have some money with SEM and some money elsewhere. So we just recommend that you do that. So finally, next question. Actually, last question. What would specifically change your investment strategy if there was a downward turn in the market for an extended period of time? So really, I say it's the same as it's always been. The decline in the market that's accompanied by poor internal indicators. Our dynamic programs would be looking at poor economic growth. That's what we would do, and we'd follow it. I was thinking about this, and I tend to be, my nickname's Mr. Sunshine, and so I focus on the negatives. But if you think about it, I jotted down a few things. Look at all the difficult times the markets have gone through. World War I, the Great Depression, World War II, the social uprising of the late 60s and early 70s, which I think is a good parallel of what I will be facing in 2020 to 2024. The hyperinflation of the late 70s, the 1987 crash, the subsequent savings and loan crisis and the failure there. Obviously, the bursting of the tech bubble. You had some other minor wars in there. You had September 11th, the financial crisis. I mean, what else can you throw at the market? You know, we're prepared. Now, I could make a case that it could be a lot worse and it should be a lot worse. But even if it is, that's what's been thrown at the market. Our systems have been tested over all these times. We've been around for 26 years. We've survived 2 implosions of some huge bubbles. That's how we're here. And so our plan is to just be diligent, continuous improvement, always working on new trading systems, always evaluating our other ones. So that's what we're here for. If you're not an SCM client, I at least encourage you to keep checking out our blog. If you are and you're questioning at all your strategy, get with your financial advisor. We'll circle back. We'll look at your plan, make sure that you're in something that's comfortable with you. But, you know, just stay focused on the big picture, stay focused on your plan, and keep checking out the blog.